Welcome to Market Plainly. Today, we're doing an explainer on something absolutely massive, the hidden architecture of our global economy. You know, when you tap your plastic or your phone at checkout, you probably aren't thinking about the invisible digital plumbing making it happen. But behind the scenes, there are these infrastructure giants keeping global capitalism humming. Today, we're unpacking one of the biggest of them all, Mastercard.
Right off the bat, let's clear up a huge misconception. Billions of us carry a Mastercard in our wallets, right? But here's the kicker. The company takes literally zero credit risk. They do not issue a single credit card. They are not lending you the money for those groceries, and they don't lose a dime if someone defaults on their debt. So how on earth are they making billions of dollars every single quarter?
Well, it's because they operate as an asset-light tech platform, not a bank. And that model helped Mastercard hit a staggering 60.8% adjusted operating margin recently. To put that into perspective, that is insanely high. The cost for them to route just one more transaction is practically zero. They don't need to hold massive cash reserves for loans. They just provide the ultra-secure digital rails connecting the banks that actually hold the money.
Let's get into exactly how they pull this off. Section 1. Decoding the four-party model.
The second you swipe, a crazy fast, highly choreographed dance kicks off between four players. You, your issuing bank, the merchant, and their acquiring bank. It's a three-stage sequence. First up, authorization. The store's terminal pings Mastercard's network to ask your bank, hey, do they have the credit for this? Second is clearing. At the end of the day, Mastercard crunches the numbers on who owes what globally. And third, settlement. That's when Mastercard literally tells the banks to move the actual funds.
Now this setup brilliantly shows us where the risk lives. Mastercard runs an open-loop system. They act as the middleman, but they pass all the default risk straight to your issuing bank. Contrast that with American Express, which is mostly a closed-loop system. Amex is the network and the bank, meaning they actually carry that consumer debt. If a customer doesn't pay, Amex takes the hit. Mastercard, not their problem.
Which leads to a really crucial point. You know those hefty interchange fees merchants always complain about? Mastercard doesn't keep those. That money goes directly to your issuing bank to cover their credit risk and fund your reward points. Mastercard's actual profit comes from network scheme fees and data processing assessments. They charge the banks the toll just for the privilege of using those secure rails.
All right, let's move on to Section 2, the cross-border money machine.
This part of the business is an absolute cash cow. And what's wild is how these international fees get triggered. You'd think you only get hit with a few when your dollars are actually converted to euros, right? Actually, no. The second a card issued in one country is swiped at a merchant legally registered in another, bam, elevated cross-border fees, even if the currency doesn't change at all. It is entirely about the geographic mismatch between the banks.
Looking at these fee tiers, you can see just how granular this gets. Mastercard's baseline fee is just a tiny fraction, like 0.1% on global volume. But let's say a foreign card is swiped in the US and settles in dollars. That fee suddenly jumps to 0.6%. Settle it in a foreign currency, now you're hitting a full 1% assessment. This geographic toll booth is exactly why global travel and cross-border e-commerce are massive long-term growth engines for them. All these microscopic fractions of a percent, they add up to billions. Looking at their target revenue mix, those scheme fees make up the lion's share, around 75%. The rest comes from currency conversions and value-added services. Ultimately, it's a sheer volume game. When you have nearly 4 billion Mastercard-branded cards out there in the world, taking a tiny slice of everything creates an absolute economic juggernaut.
But look, the very nature of money is changing, and they know they have to evolve. Section 3, Beyond Cards, Future Tech.
They aren't just resting on their laurels. They're dumping money into value-added services, and it's driving a huge chunk of their new revenue. We're talking AI for cyber intelligence, expanding open finance APIs. They even want to be a multi-rail payment utility. They're also diving into agentic commerce. Imagine autonomous AI agents securely buying things for you. It's like having a digital assistant that actually handles the checkout. Totally wild new frontier.
A great example of this tech push is network tokenization. Instead of transmitting your actual 16-digit cart number, the system swaps it out for a secure digital token. If a hacker intercepts it, completely useless. This tech drops e-commerce fraud by up to 45%, while actually bumping up transaction approval rates. It is a massive win-win for merchants and shoppers. And yeah, of course, Mastercard charges for the service. Now, while Mastercard is the nervous system for our daily consumer spending, there's another hidden giant for institutional wealth. Section 4, the BlackRock Risk Parallel.
You probably know BlackRock as a massive asset manager, but they also run this proprietary software suite called Aladdin. And Aladdin is an absolute titan. It monitors a mind-bending $25 trillion in institutional assets. It's constantly running global risk simulations and millions of daily calculations for thousands of clients. It literally acts as the operating system for a huge chunk of the global financial market. If you put these two giants side by side, the scale is staggering, but they operate completely differently. Mastercard is out there routing millions of low-value, high-frequency consumer transactions, but they don't have a say in corporate governance. BlackRock, though, they allocate massive long-term institutional capital. They act as a universal fiduciary owner, casting incredibly pivotal proxy votes across global markets.
Of course, when you hold this much power, people start asking questions. Section 5. Navigating power and scrutiny.
Running the core infrastructure of the modern economy puts a massive target on your back. For Mastercard, that means constant battles over interchange fee caps and antitrust lawsuits. For BlackRock, it's debates in Washington over whether they should face strict bank-like capital requirements, plus huge ideological pushback at the state level regarding how they actually invest. Take the housing market, for example. You've probably seen those viral social media posts mixing up BlackRock with Blackstone, claiming they're buying up every house on the block. Well, the data paints a very different picture. A 2022 Urban Institute study showed that all institutional investors combined hold just 3.8% of the single-family rental market. BlackRock mainly deals in mortgage-backed securities. They aren't out there directly outbidding you on a suburban house.
They're also catching heat over corporate governance. Look at a recent antitrust lawsuit in Texas over ESG policies. While competitors like Vanguard decided to just settle for almost $30 million and back away from climate coalitions, BlackRock dug its heels in. They fought it in court, arguing that their clean energy analytics aren't political. They are just giving investors the risk data that the market is actively demanding.
So, we've unpacked a ton about these invisible empires today, and I'm really curious to hear from you. Drop a comment below. What do you think is Mastercard's ultimate moat? Is it the massive scale of their global network, their insanely good security tech, or just the pure genius of their asset-light business model? I really want to know what you guys think.
If there's one thing you take away from this explainer, let it be this. Companies like Mastercard don't actually own the money. They take practically zero financial risk. But by owning the digital rails that let money move, they've set themselves up as the indispensable toll booths of global capitalism, collecting a tiny, highly profitable fraction of our daily economic lives.
Thank you so much for watching. If you love peeking behind the curtain to see how business, finance, and tech really work, make sure you hit that subscribe button for Market Plainly. We absolutely love breaking down these massive economic engines into things we can all understand.
And definitely stick around for our next explainer in the Business Empire series, Visa Explained. We'll be looking at Mastercard's biggest rival and seeing how two massive companies built virtually identical empires to fight over every single transaction on Earth. Until then, ask yourself, as we race toward crypto and decentralized finance, how long can these centralized toll booths hold on to the global economy? See you next time.